Okay, so let's crank this up again and look at depreciation with salvage value and a few related things. So let's jump right in on this concept of salvage value with an example. Let's say that Container Space's policy is to replace its mills every 5 years for reasons of obsolescence and reliability. And they estimate that their mill bought in 2007 for $50,000. At the time when they bought it, their best guess was that they could sell it for $12,500 at end of year 2012. So it still is going to be at the end of the useful life for them. They don't want to use it in their shop anymore, but they will sell it to a refurbisher or a startup that needs a really cheap machine, something like that. Okay, so when they're going to sell it, the amount they estimate they're going to sell it for at the end of the useful life is called the salvage value. So in this case, that is, like I said, 12,500. Okay, so what CS wants to do now is depreciate enough per year so that the book value left at the end of 5 years is $12,500. And let's see if we can do our journal entries for this one and see all the details along the way. So when we buy the mill, as usual, it's going to be 50,000 out the door that pay in cash. So 50,000 CR cash there. So we've got this all up at the top, okay? And now is a good time to compute the depreciation per year, okay? And the way we do that is to say that that's equal to, now in this case, this might be a good formula to remember, the cost minus the salvage value. So that'll be 50,000 minus 12.5 thousand divided by the useful life of 5 years. So what they're going to do is depreciate 7.5 thousand per year, and after 5 years, that's going to leave them with 50 minus 37.5K left in as salvage value. Okay, and that'll be their 12,500. Okay, so when we get to their first year of owning this mill, we want to reduce the book value now by 7.5 thousand, okay, not 10,000, okay, not 10K anymore, and they're going to incur that expense. So exactly like we've had before, depreciation expense, now it's 7.5 thousand, and we have our pilot fish accumulated depreciation account, which measures total wear of this mill from inception of its life. Okay, and as usual, no entry to the net mill, the mill asset account, which remains at 50,000. All right, so on their balance sheet, the mill asset is going to be shown at 50, okay, at the end of 1 year, 2008, and their accumulated depreciation is going to be 7.5, and the book value of the mill is going to be 42.5, okay. And their income statement, they have some revenue, some expenses, and we get down to their depreciation expense, and that's the 7.5 thousand they've declared for depreciation expense for this year. Okay, so now I'm going to jump all the way to the end of the mill's life, end of 5 years, 2012. Okay, so as usual, for the last year's worth of wear, we need to record the depreciation expense again and note that in the pilot fish accumulated wear account, accumulated depreciation account, okay? But now also we have to ask the question, do they still have that mill asset anymore? No, they have a salvage value asset. They have that mill has morphed from something they're going to use to make money for a long time to something they just want to sell as soon as possible. Okay, so the first thing we want them to do is say, hey, we don't have this mill asset anymore. All right, so we got to deal with that. So we're going to say 50 there. Okay, the CR mill asset of 50. So the mill is gone. So remove the mill, okay, from their books. All right. And now, how much is in the pilot fish account? Well, it's not 50 anymore. It's 7.5 times 5, right? Okay, and that's 37.5. All right, so that removes also this. Okay, so right, remember the rule is when the shark goes, here's the shark, the mill shark, the pilot fish goes with it. So they both go down to 0. Okay, and do debits equal credits? No. Okay, so what happened? This gave us birth to and new asset called equipment held for sale. That's a good name because it tells us it came out of PPE, and it also describes that they're trying to sell it as soon as possible. So that's DR because this is a new asset that they're getting of 12.5. Now debits equal credits and everything looks great. Okay, so let's look at the balance sheet for 2012. We have the mill and its accumulated depreciation are not shown, right? Remember our rule is when the balance is equal to 0 for any account, we don't show it. But now they do have this new asset, equipment held for sale, 12.5 thousand. Okay, what's their income statement going to look like? Here's their last year's worth of depreciation expense, 7.5 thousand. Remember, income state always for the period. This is a 1-year period, and balance sheet is always cumulative going back to inception. All right. So now what could happen next? Well, clearly they want to sell this sucker, right? They don't want to use it anymore. They don't want it taking up space on their shop floor. Okay. So let's say someone walks in, and now we're in the year 2013, the next year. Someone walks in on the first day of the year, and they say, I'll offer you 13,000 for that mill. So do they want to, does CS want to say, no, we thought that this should be sold for 12,500, so we'll sell it to you for 12,500. Of course not, right? So they want to say, yes, that's great, we'll take it, and they probably don't tell the customer it's 5,000 more than they estimated the value should be, well, even though they estimated that 5 years ago. Okay, so then they get the cash in this transaction, okay, and now, as always, ask the question, do they still have this asset, this equipment held for sale asset? No, so we need to remove that. That came in at 12.5 thousand, it never changed. It goes out at 12.5 thousand. So do debits equal credits? No. So what we have to do, this is something new, okay, and this is by definition, so that means you've got to memorize this. Okay, you got to memorize this, that the amount over what we estimated the selling price of something for is always called gain on sale. So we estimated the selling price at 12.5. We got 13 for it. So the difference here is 0.5K of gain on sale. And this is really weird. This is a type of revenue change in equity. Remember, we said revenue and expenses were due to day operating stuff. Well, definitely selling used equipment that they can't use well in their shop anymore is not part of their day to day business. So, this is, of course, one of our infamous exceptions in accounting. Okay, so this is an exception to the rule that revenue and expenses are only for normal day-to-day operations. Okay, when we sell PPE or sorry, not PPE, yeah, PPE. When we sell PPE for more than the estimated salvage value, okay, we call that amount gain on sale. Okay, and what would you expect if we could only sell it for 12,000? We would call that loss on sale, and that would be a type of expense. Another thing we need to know about this, by definition, this is important, okay, and gain or loss on sale are reported just above our tax line if we have a tax line. For REITs and LLCs, we probably don't. Um, and it's going to go under this little subheading that's going to say something like other revenue expense. Expense in parentheses here means this would be a negative number. Other revenue would be a positive number. Okay. So let's see what their income statement for 2013 is going to look like with the sale of this equipment and the gain on sale. Okay, so they have some revenue, they have some COGS, depreciation. They're definitely not going to have the mill in there for depreciation anymore. Um, and then we get just above their tax line, and we have this new section called Other Revenue or Expense. So they have gain on sale of equipment. This is the 13,000 minus the 12.5 thousand, and they might have loss on sale of something else. So typically, these are not necessarily netted out. Okay, you'd show gain on some things, loss on other things. Um, so that's the way this works. So by definition, okay, if we have some equipment, some PPE held for sale at a salvage value estimated price, we sell it for more than that. By definition, the difference goes to gain on sale, and that's considered this weird type of revenue. That'll be a change in equity, and it will show up on our income statement in this section, other revenue or expense. Okay. All right. So very quickly, let's say that in some year, Container Space they just bought a new mill and they have a CFO who's going to retire after 6 years. So end of year 6, that's the year they'd be selling the mill in. Okay. And let's say his retirement bonus is tied to the net income of the firm in his last year of employment. This is not uncommon, especially for state and city employees. That's why they have so much overtime in their last year of employment. And let's also say that this CFO is unscrupulous. Okay. So, what could he do now to make Container Space's year 6 net income look great? Well, if he was unscrupulous, he could say, for example, let's not assume that we have salvage value of 12.5 thousand for this thing. Let's say 0, even though he knows full well that on average they're getting around $12,000 to $13,000 for their 5-year-old used mills. Okay, and then how's this going to play out here? So in this case, if they got 13,000 for it, what would the gain on sale of equipment be? It would be 13,000 because they expected nothing. and that would give them 13,000 more net income than they would have had otherwise. Okay, that is a fraud jail situation. It's kind of arguable because you could say, well, technology is changing in the mills. We don't think they're going to be worth anything anymore. It's the type of thing that firms and their auditors get into big fights about. But you got to be very, very careful about that, and that would, in general, violate the consistency concept, which we're going to get to in a minute. Okay. All right, last thing up is let's talk a little bit about taxes. Okay, so as we know, for REITs and LLCs, but also true for S corporations, the entity itself pays no income tax. Okay, firms' profits are declared on owners' individual tax returns, and the owners pay firm-related income tax on their individual tax returns. Okay, for C corps, it's a different story. Okay, entities' income tax is set by the IRS, and they pay tax based on what the IRS calls taxable income, which is very similar to, especially for simple companies, GAAP earnings before tax, which is revenue minus all your expenses except tax. Okay, and the IRS sets the tax rate at 15 to 35%. It's changing a little under Trump, but the basic idea is still there. Okay, and used to be, this has changed in the past year, but if you made more than 18 million earnings before tax, you'd be paying 35%. Okay, so the implications are that C Corp's owners are double taxed. Okay, how does this work? Well, the C Corp pays income tax on its taxable income, and then any leftover cash can be used by the owners, taken out by the owners as dividends. But then the owners also have to pay dividend tax on their personal tax returns for the dividends. So that's what we mean by this double taxation. REITs, LLCs, and C Corps avoid all this for the owners of entities. Okay, so let me just write that in. REITs, LLCs, and S Corps. Okay, so that's why, unless you want to be like tomorrow's Google Today or Bechtel or Simon, well, not even Simon Property because they're a big firm that can't qualify as a REIT, and you want to have publicly traded shares, best to try and form yourself up as an LLC, an S Corp, or a REIT. Okay. A few things to note. Taxable income is not necessarily the same as earnings before tax. We're going to leave that to an advanced tax class. Taxable income is computed on what's called, of course, we know your tax return, which is very similar to a GAAP income statement. Okay. And so here's an example. So let's look at Container Space, their income statement. And remember, they are an LLC. So they do not pay income tax at the corporate level. So their income statement, very similar, simple, some revenue, some expense, net income, no tax line. Okay, and so the question is, what would Container Space's GAAP income statement look like if it were a C Corp? And two things happened. Their taxable income was equal to their GAAP earnings before tax. We want to do that just to keep things simple. And let's say their tax rate is 33% of taxable income. So let's check this out. In this case, when you're a C Corp, doing your income statements is a two-step process. Step number one here is that you do everything except for tax. So we have our revenue, our expenses, that's our earnings before tax. And in this simple case, let's say it's exactly the same, that's taxable income. So now the IRS says you have to pay tax on that, 33% in their case, on that 8.1 $5,000. So that's the next step, is you make the journal entries for paying tax. So that's going to be tax expense, 33% of 8.1K, which is 2.7K. And then we have accrued tax liability because we don't want to pay this until we really have to. That's a liability. It's not AP because the IRS does not invoice you. You are expected to figure this out yourself and pay it. Okay, so now finally, with those two steps in hand, we can complete the income statement for Container Space as a C Corp. We have revenue, all their expenses, earnings before tax. Last thing before net income. The last thing before net income is the 2.7 thousand tax. We subtract that from earnings before tax, and we get their net income, which is less now, $5.4 thousand. So that's the way it would work in a nutshell for them as a C Corp. Okay, and let's see, we talked about this. In dealing with the IRS, do we want to maximize profit? No, right? In dealing with the IRS, we want to be legal, right? But have small profits, right? Have low profit to pay less tax. And if you are extraordinarily patriotic individual corporation, that's fine, that's great. I would argue you would still want to operate this way. Definitely be legal, right? But take advantage of all the things that you can that are legal to make yourself look less profitable to the IRS and pay less tax. And then you can donate some of the profits that you get to whatever government entity that you feel patriotic about and want to donate to. Okay, so let's quickly finish up here with our last two concepts, consistency and materiality. These are both intuitively obvious once we see them, so I'm not going to put stars by them. Okay, so consistency just says treat similar items in a consistent way. Use the same treatment from one period to another. So this would be a case where Container Space's CFO would come under a lot of scrutiny if he changed the salvage value of the mills all of a sudden from 12,000 to zero. The auditor of the company would be concerned about that at the very least. And if they were a big multi-billion-dollar company, the SEC would clearly probably want to take a look at that themselves. And the materiality concept says that we want to report everything that is material, and we don't really want to ignore anything. Let me make a change there. Let's just say aggregate non-material items. So, for example, we definitely depreciate trucks, equipment, maybe even computers, but we don't want to, every time we sharpen a pencil, that pencil, right? So what we're going to do with the pencil is just when we buy it, expense the whole thing, right? Because it's a small item, it's not going to last long, etc. So that's what materiality is all about. And on that note, I think that's it for this chapter. So I'll just put a finished up here, and we'll see you all again very soon.